Joey, mate, we have got another super exciting guest today. A big friend of mine, Dave Johnston. He is the mortgage strategy specialist. And I think it's a really super critical topic that we sort of cover early in our podcasting journey, because for me, well, I don't know, you probably heard I say it 1,001 times, but property is really a game of finance. If you can't secure property, if you can't secure the borrowings, how are you going to buy these properties? So it's really important to get that mortgage strategy down packed nice and early. And I guess that's why we've got Dave on. But Dave, how are you, mate?
Very well, thanks, Jordan. Good to be here. Good to meet Joey. And there's no doubt mortgage strategy and finance is critical to the property journey.
Yeah, and I think it's really timely that we do jump this podcast in kind of early on in our scheduling, just because so many people just get it wrong. They stroll in, or they get advice from mum and dad, and we know bank, or we used to know bank manager X, and we just stroll in the front door and try and obtain a loan that way, and really kind of forgo. It might be borrowing power, it might be rates, it might be product. There's so many other things that aren't taken in consideration when you just walk straight into a particular bank.
Yeah, I think you touched on a really good point there, Joey. It's so typical for every mum and dad investor to, walk into the bank that they've had their savings account with since they were 5 years old, or wherever it is, and try and secure a loan that way. That's what's familiar, and what they get. They've got recognition and they're happy with the bank. But we're really trying to blow that out of the water today. And Dave's been doing this for, I'm not going to say how many years, but a couple of years. And
don't give away my age.
But there's a lot of wisdom in that age, and really he's kind of knuckled this down to sort of 5 core mortgage strategies. Dave, do you want to maybe touch on those and what they entail?
Yeah, absolutely. So over my many years in providing mortgage and property advice, I started to understand, I guess, that there's a lot more to it beyond, understanding the products and interest rates and all, lender policy. There's also mortgage strategies that can help you create wealth and protect your wealth, and obviously invest in property. And so, because the industry's been set up around selling products and basically focusing on interest rates and people buying often based on an interest rate, it hasn't really been explored, the strategy side of things. And so, that's something, I guess I continued to delve into to understand how you could use mortgage strategy to create wealth. And so the 5 areas or strategies that we break it down to are offset optimization, which really greases the wheels of the other strategies, optimizing tax deductions, money management, risk management, and your ability to hold property. So they're the top 5 strategies. I've actually recently added into our mortgage strategy report a 6th one, which is your repayment strategy, because that actually interconnects with a number of the strategies as well. So, look, they're the 5 or now 6 top mortgage strategies, and so there's different components to each of them.
Yeah.
Why is it so? Sorry, go John.
Yeah, I totally agree, and I just wanted to say for the listeners, they sound pretty high level in terms of the 5 topics, but every time I catch up with Dave, which is quite regularly, he gives me some new insight or some new information about what it kind of entails, and it goes into so much depth. So although you might think, repayment strategy or, something that's really high level, it's not just how you make your repayments. These, you're really getting into numbers here, and how tax impacts things, and how, long-term big picture, what does it look like in 30 years rather than, I'm just paying $2,000 today towards my loan. It really dives into things. So we'll try and get into as much depth as we possibly can today, but really understand that it does go pretty deep into things. And Joey, I know, this is something that we're constantly learning on our property journeys as well.
Yeah, you hit the nail on the head there. And David, you mentioned something that really caught my interest, and one of those strategies being like the ability to hold on to a property. That might be a segue into the next question that we're going to ask, but why is it so important that we get that mortgage strategy right from the outset? And I suppose the emphasis is on the outset.
Yeah, so with most people who we meet who own multiple properties, they have some problems with their mortgage strategy where they're essentially bleeding some wealth. And in terms of the holding property perspective, as you guys I would well know, and you'd be trying to educate your listeners on. And one of the killers of our wealth is selling property we otherwise could have held. And so there's this really critical interconnection between your property plan and your mortgage strategy, and making sure they align. And often we're buying property and we're not looking more than 1 to 3 years ahead. And if we aren't looking longer term, we're not really considering the impacts of future property decisions that might cause us to then sell properties we've already purchased. And that's where mortgage strategy can help you hold property. And so one of the key ways is preserving tax deductions. And that particularly can be the case if you own, for example, a stepping stone home. And you'd like to keep that on your journey, and as you move towards a long-term home for your family, if that's one of your goals. And so counterintuitively, and through the use of offset accounts, it actually can make sense to pay interest only, or at least the minimum principal and interest, and put all your surplus, what would have been repayments, into an offset account that you don't touch. And that way you're not paying down the loan balance, because every time you pay down a loan balance, if that's going to become an investment property in the future, well, you can't just redraw that money and then claim the interest on it like a lot of people think you can. So you're costing yourself I'm already connecting a few, making it a bit complex. But these things interconnect. So, that might be the difference between not only being able to claim more tax deductions on a property, and your listeners and you guys are still, relatively young, that you're able to hold for another 30 years plus. But even so, those extra tax deductions might work into hundreds of thousands of dollars over your lifetime. But holding that asset could add an extra $1 million to your bottom line in retirement. So we're talking about big outcomes through an effective mortgage strategy. And they're just a few examples.
Yeah, Dave, I
how
wouldn't
it interconnects.
I wouldn't be too worried about getting too complex, mate, here. I mean, everyone can start to already see how the web starts to spin itself and goes into depth and further depth, and, planning these things out pretty significantly. Couple of terms there that people might not be familiar with. If you're not sure what an offset account is, it's essentially just a separate account that's attached to your loan, and it reduces the amount of interest you pay based on the amount that's in there. So say you had a loan of $500,000 and you had $100,000 in your offset account. Well, instead of paying interest on $500,000, you're only paying interest on $400,000, because that $100,000 in the offset is essentially offsetting the $500,000. And Dave, you mentioned something really early on in that question that was really key, is being able to hold on to a property, selling a property when you might be able to be holding on to that property. I know you've got a bit of a story yourself where, you sort of hit that pain point when you were younger on in your property journey. Do you mind sharing that with the listeners?
Yeah, absolutely. So, I've sold 2 properties that I wish I had have otherwise kept. And, one was probably late-ish 20s, and then one was early 30s. And, I pretty openly say, probably heard on my own podcast, we had an episode on our biggest mistakes. And, in essence, those 2 sales had probably cost me $1 million plus. And I probably could have found a way to hold them, but I didn't have the knowledge or foresight at that point in time that I do now. So obviously, that's one of the things we try and educate, listeners through podcasts like this, or through, work we do with writing, and obviously through our business as well. So yeah, that it's a big lesson, and it doesn't mean you can always hold every property, because the unique thing about property is it's the only asset class we live in. So you've actually got to weigh up your lifestyle priorities alongside your financial priorities. And obviously they can clash. And that's really the crux of one of the key reasons property investment is so difficult.
Yeah, and I think it's just always going to serve you as that lesson. And even for myself personally, like what you mentioned before, like I've only now in the last 12 months gone, damn, I wasted 4 or 5 years, not wasted, but paying P&I on an investment property that I was never going to live in.
Yeah.
And I mean, like I bought the property when I was 21, so I would have had such a horizon in terms of saving those tax deductions for later on. But it's now, unfortunately, too little too late for me. So we live and we learn, and again, try and tweak around that strategy as we go along. But Jordan kind of alluded to it a little bit, but it's a question that often comes up, particularly in and around our demographic, as you're just starting to dip your toes in the investing waters. But do you mind outlining the difference between offset and redraw?
Yeah, so as Jordan just touched on, basically an offset account is a savings account. So it's just like a simple standard savings account, but every dollar that you put into that 100% offset account is the same as if it went directly into the loan. And so how I try to demystify mortgages for younger people, particularly first-time buyers, is thinking of a loan account as another bank account. It's just another bank account. Unfortunately, it's in debit, but it's just another bank account. And an offset account is a different bank account that's in credit, okay? Versus a redraw is when you pay down your mortgage, and every dollar over and above the minimum repayment you make, that is how much you have available in redraw. And basically you can access those funds on variable rate loans. Generally, most fixed rate loans don't allow for redraw, and most of them don't allow for 100% offset account. And that's another topic I think we might be coming to. But in essence, so they're different, and it's really important that you understand that, because the offset account provides a really clear delineation that allows you to preserve tax deductions. And not only that, you can then build up your savings if you're going to buy a future home, so you'll have less debt on the future home, which is non-deductible. So there's actually a double-edged benefit by using the offset account and preserving the loan balance. Counterintuitive to what mum and dad taught us all, pay down your loan and pay it down as fast as you can. So this is one of those tricky things for people to comprehend, because it really jars on what we got taught growing up.
Exactly.
Yeah, it's such a hard one to rewire. Like, a lot of my friends have, got into their first house now, sort of in the 30, I'm nearly 30, which I don't necessarily want to say, but a lot of my friends have sort of bought their first house, and all they're thinking about is just paying down debt as quickly as they can. It's such a hard thing to rewire. For the listeners that picked up on Dave mentioning that he had a podcast before, it's actually called The Property Planner, Buyer and Professor. I'd highly recommend it. It's got two other really good guests on it, as well as Dave. Kate Bakos, who's a really well-renowned buyer's agent, and Peter Kalizos, who is the property professor who teaches a Master of Property over in, I think it's the Adelaide University or something like that. But great podcast. Highly recommend it. I've listened to every single episode, and I'm very proud that I can say that.
Thanks for the plug.
No, that's all right. Cool. I think one thing I think we should really mention is on the mortgage strategy side of things. Is it something that we can sort of set and forget and then move on, and that's the mortgage strategy for forever? Or is it something that we have to sort of constantly revisit and update?
It's something you need to constantly revisit, because your life decisions are changing, your property plans are changing. So it needs to align with your property, financial and lifestyle plans. And so you need to revisit it and ensure you keep aligning it with your pathway forward. And that's through, your risk management system. That's through preserving tax deductions. That's through how you manage your money, and, optimizing offset accounts interlinked with your mortgage to set up an effective money management system. That'll evolve. As you have more debts, it gets more complex, guys. As you have more kids, it gets more complex. So, you need to keep revisiting it.
We've kind of mentioned the offset account a little bit, but do you want to just kind of, we'll do a bit of a deeper dive into it and just kind of reveal a little bit of the magic behind the offset and why it is so important?
Yeah, so look, the offset allows you to, as we touched on before, if you're not making the repayments and you're putting it into the offset, well, then you're not paying down the loan, so you're preserving the balance and therefore future tax deductions. Plus, you're able to use the cash towards a future home. Many lenders will allow you to have multiple offset accounts. So we educate our clients on how to set up a money management system that works for them, personalised to them. We have buckets called Grow, Life and Fun, and then your investment bucket, and people can have more buckets.
And so they all link to the one. So let's say you've got property X offset, and then you've got sub offsets against that, and they all link to that same asset.
Absolutely, yeah, that same debt. Yeah, they can. Not every lender offers that though.
Yeah, I was going to ask that actually. Is there certain lenders that is it very specific, or is there a certain type of product that you have to go for to do it, or is it sort of lender specific?
So most lenders nowadays will allow you to offset against variable rate loans, but less than half would allow multiple offsets linked to one mortgage, and generally that'll be your home loan, because that debt is not deductible, which means you don't get to claim the interest against your income.
And Dave, I'd imagine you get this question pretty often, because I know that these packages often come with a loan package fee or an annual $395 or whatever it is. What do you say to clients that say, well, I don't really want to be paying package annual fees?
I'd say you're focusing on the small stuff. Let's get the big stuff right first. Let's get your mortgage strategy right. Make sure it's matching what your future property plans are. And then once we're clear on that, let's find the most appropriate lender for you. And if it happens to be under a professional package, which generally they are, where you get sort of more bells and whistles and you pay an annual fee, so be it. I wouldn't be losing sleep over that. It's a bit like, getting too caught up on a tiny differential in the interest rate. I guarantee you the best rate today when you're looking for a loan will not be the best rate in a week, won't be the best rate in a fortnight. So at some point you've got to decide on the lender and understand it's not going to be the best rate in a month's time. So don't get too caught up on that. These are the big picture things that are going to set you up for the long term. Get them right.
Yeah, I think you both touched on some pretty key points there, especially around looking under the hood of the loan. They're both touched on, some of these loans have got some annual fees, but it's not what you see when you're searching online. You kind of see the best rate, and I know a lot of people who sort of just chase that best rate, but they don't sort of look under the hood and what are all the other things that come along with the loan. Is there going to be a breakage fee? How much is that fee? So really long term when you're planning big picture, and that's why it's so essential to have that mortgage strategy down packed. How's it going to impact that journey along the way? And something else Dave touched on, which he taught me, which is really important, is the buckets being or being their own individual offset account. So I had my own mortgage strategy money management system beforehand, and had my own buckets, but 2 or 3 of those buckets weren't linked to an offset account that's going to offset against my debt. So I think that's a really critical one. And although it might seem small to some people, I think it's super essential. And as Dave touched on earlier, that's where you sort of bleed your wealth long term, right? If you don't have it attached, it's not interest that you're saving. So I think it's time for 2 really key questions, and probably something that everyone asks when they go to get a loan. The first one is, should I stay fixed or go variable?
That depends.
I love that answer.
So look, there, like with all of this, there's a number of questions or considerations underneath that. So basically, fixed rates are less flexible. And really, fixed rates are like insurance. It's a way of managing risk. And, no one's got the crystal ball to know for sure what's going to happen in the future around interest rates. Now, definitely at the moment, fixed rates are as low as they've ever been. They've just started rising. So there certainly is a case that now's as good a time, and there might ever be again in the future, to be locking in some debt. But the question still is how much debt. Generally, discounted variable rates are slightly lower than fixed rates, although there's some pretty amazing fixed rates on the market at the moment. But really it should align with your risk profile, because what you're buying is certainty with a fixed rate loan. So your risk profile, as well as the amount of risk you've got at the moment. If you've got a lot of debt, you don't have a lot of spare cash flow, you don't have a big buffer of savings, then I would say consider fixing some of your debt to manage risk. If you've gone aggressively with an investment strategy and you've got a lot of debt, then I would say manage your risk through fixing some debt. I would never say fix all your debt, or almost never fix all your debt, because of fixed rates having limitations on an extra repayments. Most of them have limitations on how much you can repay. And there's only a few lenders out there that allow you to offset against fixed rate loans as well.
Yeah, that's a key point, and I think it's really good for the listeners to understand that you can split loans as well. So a portion can be fixed and a portion can be variable. It's not just a straight fixed or variable. One thing I do want to touch on though, Dave, is in the scenario where someone's going through a bit of an aggressive accumulations phase. Let's say they bought property 1 and they were hoping to refinance and pull out some equity in year 2 or year 3. If they were to go on a fixed loan, say it was just the whole amount, fixed loan for like a 5-year period, what are some of the complications there with being able to refinance?
Yeah, really good question. So if you fix, then it can be quite expensive if you want to refinance during the fixed rate period. Basically, the lender has borrowed their money to then on lend to you at a margin, and so they need to recoup that cost. Now, obviously, if rates go down and you want to get out of that fixed rate, what would be the point of providing fixed rates if the banks could just let you refinance and get onto a lower rate whenever you liked during a fixed rate period? So they charge you what's called an economic cost. So there can be many thousands of dollars expense when you refinance on a fixed rate loan. So you've actually got to correlate how long do I fix for with, when might I want to refinance / might I want to sell a property, and then also you want to have at least the amount variable plus some buffer that if I'm going to fix for 5 years, I'm not selling, I'm not going to want to refinance to another lender, and how much can I save and pay off my loan in a best case scenario over those 5 years? Well, I need to have that much variable because most fixed rates have limitations on how much you can repay. So there's a few things to consider.
There is so much to consider in that situation, but even for, like, let's say beginner investors, like we've mentioned it maybe 6 or 7 times already, refinance. Why would I refinance? What's the point? Yeah,
so you might refinance, as I touched on before, there's a new best offer every week. So at some point, you're probably going to consider refinancing to access a better rate or package, So that's going to be one of the reasons. The reality is a bit like, our electricity and our gas bills. And, once you're with a provider for a long enough time,
they've got you, right?
They bank on you just staying with them, and, they offer the better offers to newcomers. So that's one of the reasons you refinance, access equity to then make other decisions. You might have another lender who'll lend you more than your lender. Your lender might not be as flexible with policy, which I guess is connected to being able to borrow more with another lender. So there can be some different reasons such as that.
Yeah, and in terms of the other big question, I think you've touched on it before, with the sort of offset account and paying principal. But if for someone who is still in the mindset of should I go for a P&I repayment, a principal and interest repayment, or an interest only repayment, what would you sort of say to them as a general rule of thumb?
Look, if it's a home, then you definitely consider principal and interest. You pay a lower interest rate on principal and interest loans. And when it's a home loan, you pay lower rates as well. So you consider it. And one of the questions you want to ask yourself, is there any chance you might want to turn this property into an investment property into the future? And if you would, that's when you want to more deeply consider whether you pay interest only on a home, even though the cost is higher, but you're going to preserve tax deductions. there's no black and white answer to that because no one knows the future. And so you might to go principal and interest, but just make the minimum repayment and put everything else into an untouchable offset account that is actually the consideration of call it like a repayment offset. Whereas if you've got investment debt, then you'll generally pay interest only. If you have non-deductible debt, because the non-deductible debt generally will be more expensive because even though the rate might be lower, which is, I think, one of your points, like the investment loan might have a higher interest rate, but once you factor in your tax deduction, it actually ends up being truly a lower interest rate than your home loan rate. So again, a bit complex, a little bit hard to understand, but in end dollar terms, it's cheaper for you. So if you've got home loan non-deductible debt, you generally might consider principal and interest. If you've got investment debt, interest only. But also if you plan to get non-deductible or purchase a home in the future and you only have an investment loan at the moment, that still would be a reason to pay interest only on that investment property because you want to be building up your maximum, same things we've been touching on, build up your maximum savings so you have less debt on that home when you buy it in the future, even if first time buyer, your first property is an investment, and you're preserving the tax deduction. So very counterintuitive. But hence why repayment strategy, I've added it as a sixth strategy.
Yeah, it is just so complex. Like, I mean, even just the questions that you're asking, like, is that property potentially going to become an investment property for you one day? Like, you might not even know. Like, you might go, yeah, you know what, I'm happy with this as my property. It's going to be my forever home. But your circumstances could be drastically different in 8-10 years time, and then all of a sudden it's not. So you've done P&I, and you potentially, in hindsight, should have done IO. It's just it's just such a calls the need for strategy. Firstly, that you really need to be giving it some thought, because if you're not giving it any thought, then you're not giving yourself any chance at all. But even like once you've done that, it's just so dynamic, and potentially the reason why you do need to be doing regular check-ins to not only with the portfolio but your mindset and your future plans moving forward.
Great points, Joey. And two of the key questions to help simplify it to some degree are, do I think I'll buy another home or a future home? Okay, because then that feeds into most of these strategies. And do I think my current property, I'd like to hold on to it? So they're two key questions. And if the answer is yes to one or both, then you really owe it to yourself to then unpack these other questions to get to the right solution for you.
For sure. Yeah, that's such two really critical questions to ask yourself. And I'm sure, Dave, there's a number of hard topics or hard conversations that you potentially have to have with your clients and trying to explain how everything works. If I was to play devil's advocate on just one of those, and probably something you hear pretty common is, why are you presenting me this package when this other package got a much lower rate? Why wouldn't I just go for the lowest rate?
Yeah, it's a really good question. What we would say is, well, firstly, have we got your mortgage strategy clear? Now, if we've got your mortgage strategy clear and we've done all the things and more that we've talked about, then we'll say, look, let's find the best interest rate for you. Now, my strategic mortgage brokers, my company, we have access to about 40, 50 lenders, and we're not in the quoting game, okay? Because if you just want to find the cheapest thing out there, you don't need a strategic mortgage broker, because anyone who's above the age of probably my 7-year-old can look and see 4.2 is higher than 3.2. All right. Yep. So if it's that simple, you don't need a strategic mortgage broker, and do it yourself. And that's fine. You've got to do what you feel right, what's right for you. But, if you want to work with people who are going to guide you and give you the strategy and the education, then there's a cost to providing that time and service, like with any profession. And so we actually get people to make a commitment after, probably initial discovery call and in a meeting, and then they agree to work with us. And then, we go through and take them on that journey. And yeah, we'll obviously, ultimately, they can select any lender. We have no preferences. We are lender agnostic. So that would be my answer to that question.
And just on top of that as well, like, I personally myself, I've got and hit a certain ceiling with some of the major lenders. And do you mind talking to us a little bit about what happens when you get to that point?
Look, it's a great question again, Joey. With that, this often comes up, and particularly when we're writing property plans, but also with mortgage strategy clients, where their property strategy, and we work with around set money goals, which sets the parameters. So it's not what a lender tells you can lend. That's not how you should determine how much you spend on a property and how much you borrow. It's actually your own cash flow and safety net. And so we actually frame them and set goals with people, and then match up the purchase prices to your money goals, because everyone has a different level. That means they'll be able to sleep at night of how much cash they have in the bank and how much surplus cash flow they have after they purchase that property. So then let's say we've figured out that a mainstream lender won't lend you the money, Joey, but your money goals are fine, that you could stretch further. So then we look at second tier lenders and find a second tier lender that matches your property strategy. Again, it's marrying up the property strategy to the mortgage strategy. So then, we'll find that, and, sometimes get the interest rate's 20 basis points higher or 40 basis points higher, but pretty much any time in history, if you told them they were even getting the second tier lender rates that are available at the moment, people would go, boy, that's an amazing rate. Yeah. So everything's relative as well. So that's basically the process, we'd go through, whether it's with a strategic mortgage broker or our property planning clients who then work with a strategic mortgage broker as well.
Yeah, I think it's so critical to have those two key pieces together, being the property plan. Like for me, being a younger investor, you kind of just want to borrow as much as you can and get into the best property you can right now. But it's not until you actually stop, take a seat back, look at that sort of 60-foot view, look at, what the next 30 years may actually look like. Understand that you may only need sort of 2 to 5 purchases within your portfolio, and then go, okay, well, let's put a plan around these 2 to 5 purchases rather than just be really aggressive and get into the best asset that I possibly can. It's really critical to have that strategy put together, and both sides, the mortgage side and the planning side. But Dave, mate, I think you've touched on some phenomenal points today. I really value your time, and I really appreciate you coming on to the podcast and sharing some of your insights with your guests, mate. If you'd be up for it, we'd love to have you again on in the future at some point in time. But thank you again, mate.
My pleasure, guys. I've probably opened up more questions than I've answered, but
yeah, I was going to say I've been taking note of a few. We're going to have to go with round 2 pretty soon.
That was a reason. That was a reason to get you back on, mate.
Yeah.
All right, Dave. We'll chat to you soon,
guys. Yeah.
Thanks so much, mate.
Good to be with you. Cheers.
Thanks, mate. Bye.
See ya.